There are some concerns about corporate governance over at Canada's oldest company. HBC's executive chair, Richard Baker, of course, is in the midst of leading a go-private bid for that company. Richard Leblanc is a prof at York University. Thanks for being here.
My pleasure, Amanda.
So the thing that really highlighted this, I mean, there had already been concerns by some about the fact that this company went public at 17 again, and that the go-private is at 9 and change. So lots of people will be losing money here. But there are good reasons to go private, so we'll set that aside. It was this meeting they had last week that they barred the media from, and so there's no reporting, no kind of open disclosure, and then also tried to, or they're putting through an executive pay package for their CEO that some will say is way too high. Why would they do that? I mean, when you think of that closed-door meeting, a bit of a red flag?
Yeah, there wasn't a whole lot of transparency, and there was pushback on the executive pay. It was $29 million. Most of it was not at risk, so it was sort of guaranteed. So one of the highest-paid CEOs amid a stock price decline of 42%. And now there's as you said, there's this go-private bid of $9.75 by the executive chair. So when you look at the board of HBC, I mean, it's got 13 directors, 6 of whom are not independent, and the executive chair is also not independent. So we like to see in Canada, 98% of our companies have completely independent chairs. So we've never seen, I don't think, an iconic Canadian company with an executive chair who is leading a buyout. So arguably that is a conflict of interest, not only for the executive chair, but also for the other directors. So they should remove themselves entirely from the process and let the evaluation continue.
So one of the elements that makes this story so interesting is that one can see from the results that the retail part of HBC's business is suffering, has been suffering.
Yes.
And I say the retail part, you'd say, well, isn't it all retail? Other than the real estate, in other words. The CEO, who's being so handsomely compensated, in fact, has put the value of the real estate above this buyout price, incidentally.
That's correct.
Which I find very interesting.
Yes.
But does it make a difference that we think this might be a kind of a Hail Mary pass? In other words, Richard Baker wants to take it private because the retail business may not survive. So as it heads towards some kind of restructuring or workout or whatever that might look like, it's better to be private. Does that make any difference on the governance side as it makes its way there?
Well, it does, because if you think it's a real estate company, and the activists have said, the activist minority shareholders have said that the offer by Baker is wholly inadequate because they think that the real estate are the crown jewels, and that those can be sold off, and then HBC would pay rent. So if TD gives primacy to the retail spin versus the real estate spin, I think it would be clever for the activist to retain its own evaluator and see what other similar retail companies have done with real estate, and perhaps come at a higher price. Also, query what's the advantage to going private? I mean, if you're going private, you're not insulating yourself from real estate or retail pressures. So is there sort of postponed gratification? We're going to go private, and then we're going to implement these strategic changes. If I'm a minority shareholder, I'm thinking to myself, well, hang on a second here. Why aren't we doing these changes now when we're public? In other words, going public to private doesn't insulate you from competitive pressures. So these are some of the issues that minority shareholders will be looking at.
This is one of the questions that I had for you. Does it insulate you from anything else? Because one thing that we've seen is, of course, a company like Sears, for instance, there are lots of small creditors, there are former employees and pensions. There's all kinds of things at risk here when we contemplate
Your duty
this.
is still the same.
Exactly the same, public
Exactly
or
the same. And in Canada, your duty is much more stakeholder-oriented. You've got to look at pension, you've got to look at employees, you've got to look at the best interest of the corporation. In America, your duty is to the shareholder, but here it's much more rounded. So it's even more important that you have independence at the board table.
So one thing I wondered is whether this is a particularly Canadian bad governance issue, because we've seen other examples of where it's high dual-class shares, for instance. Maybe that's the one that's most often cited. But are Canadians good or bad at this stuff?
Well, generally we're good, but it's surprising to me that this has sort of slipped below the radar screen. It's an iconic Canadian company. It's got, normally you want to see a completely independent chair and a majority of independent directors. The only director who should not be independent is the CEO. We don't see that here. We see a heavy influence by the shareholder group and by management. And I think that has shaded the governance issues.
Great to have you here, Richard.
My pleasure, Amanda. Good to be back.
Richard Leblanc is a professor at York University.